we see three trends. One trend started before the Trump moment, was at the end of the year of last year. It was pretty clear that in the mind of many asset managers that valuation multiples in the US were very high and not necessarily justified by the prospects of growth of the local companies, and that valuation multiples in Europe were very low and not necessarily justified by the performance of companies. So basically Europe was perceived as cheap and the US as expensive, and that was before Trump. Then came the oval office volatility, and basically oval office volatility translated in market volatility, and many people decided that if you want to have your money in a predictable environment, in a rule of law environment, in an environment where the basic assumptions of capitalism operate, then Europe is not a bad place. So there was a move. And then there is and that translated into people shorting US assets to move to Europe. It was not massive, but it's significant and continuing. But the most fundamental trend is the silent trend, which is people from the rest of the world decided not to renew investment in the US that are after redemptions, or to make different strategic allocation. So it's not the money that is leaving the US to go to Europe, it's the money from the rest of the world that will not get to the US and that will go to Europe. And the way the asset class where this trend is operating in the most visible way is US debt. And that's why you see the current tension, because the appetite from the rest of the world for investing in US debt is being revisited because the US policy mix doesn't close, the loop doesn't close. I mean, the difference between the Oval Office and the rest of the world is that the Oval Office concept is it's very simple, and the rest of the world dominating concept is it's very complicated. Right. So the clash between it's very simple and there is a one-size-fits-all solution, which is tariffs, and the rest of the world, which is, well, you need to close the loop between debt, surplus, services, interest rates, inflation, is something which clashes, and therefore that translates into slow but determined fundamental reallocation of global money toward safe harbors, and Europe is a safe harbor.
It's interesting that you're seeing that at the same time when it comes to IPOs. We're continuing to see companies favor New York listings over European and British listings. Why isn't that translating to the IPO market?
Well, I think your comment is a bit obsolete. Many companies that were considering IPO in the US are revisiting their option, just because getting public somewhere is betting on set of assumptions that are implicit, that rule of law will prevail, that when you own something, you own it, not you own it until Elon Musk wants it to, that institutions do operate in a normal way. I mean, the world market economy assumes certain guarantees on property rights and certain predictability.
You say that my comment was obsolete. Are we actually seeing that transpire?
No, we are seeing that. We are seeing that. What your comment is not obsolete, to the extent that there is a general growth of IPO across the globe, and that there was a certain fascination for US valuation multiples because of the reason I mentioned a few minutes ago. This is being the fundamental equation for deciding to list in the US is when you are absolutely confident that the upside of higher valuation multiples does offset the fundamental complexity of being listed in the US, which is much more complicated, much more expensive, and much more bureaucratic than being listed in Europe. Now, sometimes valuation multiples do justify that choice. But when valuation multiples are a bit crunched, and when the complexity is becoming more expensive or more volatile or more uncertain, then the equation for Europe is becoming more attractive.